fundsupermart.com.
Can you briefly describe the investment objective and strategy adopted by the Fidelity Asian Bond Fund?
Okay, so the Asian Bond Fund is very much an investment grade focused bond product, investing into the investment grade dollar denominated instruments that we see in the Asian universe. So relative to those who are familiar with our Asian high yield product, for example, this would be the natural higher quality, lower volatility brother of that product. But the difference in that is also that when you're dealing in high yield, you're dealing very much in a credit space in terms of credit fundamentals dominating your investment decisions and your investment returns. When you're dealing with the investment grade market and you have the ability to move between government yield curves and quasi-governments and corporates, it allows you to put a far greater number of strategies into your portfolio. Now, at our heart, we are multi-strategy investors, so therefore we like to use the ability to do yield curve analysis, cross-market analysis, asset allocation analysis, down to the corporate selection at the sector level, ratings, individual issuer, individual bond level. And because the investment grade markets are far larger and far deeper, and they have that broader universe of issuers, it allows us to adopt this multi-strategy approach, which we adopt across all of our investment grade products that have this kind of benchmark, to bring in a far smoother and more reliable source of returns over time. So for investors, they should view this as being a higher quality product that can still take advantage of the Asian dynamics in terms of the economic dynamics, but using a far greater number of strategies to ensure that they get a more consistent, a less volatile amount of return within the product.
The Fidelity Asian Bond Fund has had a good year in 2012, delivering returns of approximately 10% to investors. Can you briefly explain what investment decisions have contributed to these returns?
But overall, as I say, the way we try and structure these funds with a multi-strategy approach is that through the cycle, the multi-strategy element to these portfolios mean that at different times, different parts of the investment environment allow us to pull in that return that we're trying to give for investors. So there are times when returns are particularly low in the credit space, where returns in the alpha that's generated, the additional return that's generated from government and yield curve ideas will offset some of that low return from corporates. And there's other times where, and as we've seen, the contribution of what's happened to corporates over the last 12 months and investing in credit generally, those have been strong contributors to returns. So through the life of the product, it will move depending on the environment, which is one of the beauties of the product. But if we look back over the last 12 months or so, it's definitely been credit, that additional carry that you're getting from investing in credit and credit selection that we very much pride ourselves on, given we've got such a large credit research team here in the region that have contributed significantly towards some of those returns.
What is your outlook for the Asian investment grade debt market in 2013, and how is the fund positioned to take advantage of these views?
Well, our model is very much a relative value model, and that means that at any point in time we're doing an assessment of how much return you're getting for your investment versus the risk that you're taking. Now, as we saw through 2012, and certainly at this point where the first 2 weeks of this year, we saw tremendous issuance into the investment grade markets here in Asia, and that allows us to have more opportunity set, which is clearly a positive for investors who are looking to invest into the market. So our outlook remains extremely positive. We've got through some of the question marks about China growth, and I think that sets us up for actually probably a pretty good year for the Asian investment grade markets. That, alongside the kind of issuance that we've seen and we're seeing now, means that I think investors can have a lot of heart that this is quite an attractive place to be considering investing in the year ahead and the years ahead.
What are your views with regards to Asian currencies, and to what degree is currency expected to drive the fund's returns?
Okay, so for us, currency is less of a strategy. Currency, it's something we do take advantage of, and we have got the ability to take advantage of it within the portfolio. But currency is one of those things which for us is like a secondary consideration in terms of if we're going to invest into an instrument that's not in dollars. And I say that because the benchmark, the Asian dollar investment grade benchmark that we have for this portfolio is clearly a dollar denominated benchmark. So any currency positions that we take have to be going against that benchmark in our out of index positions. So currency is one of those fickle beasts which you might get right occasionally, but it's very difficult to get right consistently. So what we do is we focus our efforts on researching areas where we feel that we can generate what's called a high information ratio, which basically means you get a high success rate. And currency comes quite low down the list of alpha generators within the portfolio. So for us, it's less of a strategy, but it's something that we do use when there's a compelling case. So investors shouldn't expect that currency will be a significant part of the return of the product.
Thank you.